Every single first Friday of the month at exactly 8:30 a.m. Eastern Time, billions of dollars change hands in a matter of seconds. Welcome to This Explainer. Today, we're breaking down the absolute beast that is the non-farm payrolls release. Look, if you're a beginner Forex or gold trader, this highly concentrated 5-minute window is either going to be a graveyard for your trading account or the absolute greatest opportunity of your entire month.
Okay, let's dive right into this high-stakes scenario. Why does this one single event routinely destroy amateur accounts while simultaneously creating massive opportunities for the prepared? Just picture the scene for a second. It's 8:29 a.m. Retail traders are frantically guessing the direction, mashing the buy or sell button, just hoping to get rich quick. Then, 8:30 hits. Slippage kicks in, stop losses are instantly vaporized, the chart looks like it's literally glitching out. We're talking about the ultimate liquidity grab. To survive this, we've got to stop treating the market like a casino and start reading it like a highly tuned algorithm. So, how exactly do we do that? Let's kick things off with part 1, the NFP chain reaction.
To stop gambling and start trading like a real professional, we first need to understand the fundamental mechanics behind the U.S. Bureau of Labor Statistics Non-Farm Payrolls report. At its core, the NFP tells us exactly how many new jobs the American economy is generating, but it specifically excludes farm workers, the military, government, and nonprofits. Now, you might be wondering why exclude farm workers? Well, it's simply because agricultural jobs are super seasonal, which would totally skew the data and hide the true underlying economic trend. So the BLS compiles this massive data set, and when it drops, it serves as a massive indicator of overall economic health. If businesses are out there actively hiring, the economy is healthy, consumer spending goes up, and inflation might rise. But if they stop hiring, things are slowing down fast and recession fears take over. Now, here's where a lot of rookies mess up. The report isn't just one headline number. The market is actually reacting simultaneously to job growth, the overall unemployment rate, and crucial wage inflation data. Amateurs, they usually just glance at the headline job numbers. But professional traders know that average hourly earnings acts as a massive leading indicator for inflation pressure. Think about it. If people are making more money per hour, they have more disposable income, right? So they spend more. That spending drives up prices, creating inflation. And when inflation rises, the Federal Reserve is forced to step in. This triad of data points is exactly what the big institutional computers are analyzing in literal milliseconds. And this sequence right here brilliantly illustrates the cause and effect chain reaction of global capital. Honestly, think of it like falling dominoes. Smack. The NFP data hits the desk. Instantly, the first domino falls. Algorithms calculate the new odds of the Federal Reserve either raising or lowering interest rates. The second domino. U.S. bond yields react immediately to those new rate expectations. The third domino. Those bond yields directly dictate the strength of the U.S. dollar, or the DXY. And the final domino? Well, because gold is priced in US dollars, as the dollar moves one way, gold abruptly reprices in the exact opposite direction. It's a literal domino effect unfolding in seconds across global markets, entirely driven by those employment numbers. So the absolutely crucial point here is the comparison between the forecasted numbers and the actual results. Let's put this into perspective with a real-world hypothetical. Let's say the forecast is 150,000 new jobs, but the actual number comes out at 250,000. That is a massive beat. A stronger than expected NFP usually boosts the dollar. The DXY will immediately spike because a strong economy implies higher interest rates. Conversely, gold, which remember yields no interest at all, suddenly becomes a lot less attractive to investors and drops like a rock. On the flip side, when the actual job number completely misses the forecast, showing a weak labor market, the dollar weakens under the expectation of a Federal Reserve rate cut, sending gold surging upward. But hold on a second. Have you ever been in a trade, seen a fantastic jobs report print green across your screen, confidently hit sell on gold, and then watched an absolute horror as gold rallies straight through the roof, taking your account balance right along with it? This is the exact trap that catches beginners totally off guard, leaving them staring at their screens in absolute confusion as the market moves completely opposite to the headline data. Why does this happen? It all comes down to the hidden nuances in the data. For instance, if average hourly earnings drop, showing lower inflation pressure, or if the unemployment rate ticks up, suddenly that headline jobs number doesn't matter nearly as much. Furthermore, there's this massive concept called pricing in. Imagine everyone already knows a new movie is going to be an absolute masterpiece before it even hits theaters. By opening night, the hype is already maxed out. That's pricing in. If the smart money bought the US dollar all week long expecting a good NFP report, the moment that good news actually hits the wire, they just sell their positions to take their profits.
This massive wave of selling causes gold to surge despite a good jobs report. It's not magic, guys. It's about what the institutional money was doing before the release even happened.
Moving right along to part 2, the ICT Market Theory. Let's jump over to the technical charts and see how this all builds into actionable strategies using Inner Circle Trader or ICT concepts. We are going to look at NFP volatility not as some kind of random chaos, but as a deliberate, algorithmic movement by smart money to manipulate prices and fill massive orders. This isn't random. It's a highly engineered computer program executing in real time, right before our eyes, designed specifically to seek out and absorb retail stop losses. First up, we need to talk about liquidity. Before the data even drops, the market is quietly building up liquidity pools. Think of liquidity as fuel. Smart money literally cannot enter a billion-dollar position without someone on the exact opposite side of that trade to buy from or sell to. They need your stop losses to fuel their massive entries. So in the quiet hours before 8:30 a.m., the algorithm lets the market consolidate. It traps early buyers and sellers, letting them build up their stop losses just above and below the current price action, creating a literal pool of fuel just waiting to be ignited.
Then, the clock strikes the release time, and boom, we see displacement. This is a violent, high-energy sweep of that trapped liquidity. Visually, on your chart, it creates the largest, fastest candles of the entire trading month. The algorithm aggressively hunts those stop losses in an instant. It's a massive, sudden move meant to trigger everyone's stops, instantly taking retail traders out of the game while simultaneously filling the smart money's true institutional orders. Because that displacement moves so incredibly rapidly, it leaves behind what we call a fair value gap, or FVG. Price literally skips over levels, leaving an imbalance or an empty space on the chart. Think of a fair value gap like a vacuum. The algorithmic market is inherently efficient, so it absolutely hates these vacuums or empty price pockets. Because of this, it will almost always want to retrace back and fill this gap to balance the books before continuing its true underlying move. For us, these gaps become prime, highly accurate targets for our trade entries. Finally, once the dust settles from the initial shock and the stop hunt is over, we are specifically looking for a market structure shift. This is your final confirmation that the algorithmic trend has decisively changed direction. You're looking for a key swing high or a key swing low to be broken with definitive energy. Once that market structure shift occurs, it's basically the algorithm's way of signing its name on the chart, telling you exactly which way it plans to trend for the rest of the New York session. The trap is fully set, the liquidity has been swept, and the real trend begins.
All right, part 3, amateur mistakes to avoid.
Before we outline the professional playbook, we absolutely have to highlight the devastating errors that wipe out retail traders every single month. Look, amateurs treat NFP like a literal casino. First, entering trades before the news drops is just pure gambling. You are literally volunteering to be the liquidity. Second, trading based purely on the first emotional candle is practically suicide, because as we just learned, that first move is often a fake out designed to wipe out early positions. Third, ignoring the deeper data like unemployment and hourly earnings leaves you totally blind to the true macroeconomic picture. Fourth, using incredibly tight stop losses during a high volatility event guarantees you'll get stopped out by the widened spreads alone. And finally, failing to understand the initial liquidity grab means you're playing checkers while the smart money algorithm is playing chess.
Which brings us to part 4, the professional NFP trading playbook. Instead of gambling, here is exactly how you survive the first 3 minutes and strategically enter the market right alongside the smart money. Let's walk through the 6-step ICT execution. Step 1, determine your daily bias. Are we generally bullish or bearish on the higher time frames? Step 2, before 8:30 a.m., map out those liquidity pools. Draw lines where you know retail stop losses are resting. Step 3, and this is the hardest for beginners, sit on your hands. Just wait out the initial news drop and the chaotic first few minutes. Step 4, watch the chart for clear, energetic displacement that sweeps those liquidity pools we marked. Step 5, once you see that sweep and a market structure shift, identify the fair value gap left behind by the displacement. And step 6, surgically execute your trade on the retracement right into that fair value gap using strict risk management. You do not have to be the first one in the market, you just have to be on the right side of the liquidity sweep. And finally, part 5, your next trading steps. Now that you understand the macroeconomic chain reaction and the technical ICT playbook, it's time to actually put these concepts to the test. But to execute these precise strategies, you absolutely need a broker with tight spreads and super reliable execution during high-impact news events. Open an account with the trader-friendly broker FXTM using the link pinned right down in the comments section below. Look, NFP is definitely not a get-rich-quick scheme. It is the ultimate test of your psychological discipline and your ability to read the algorithm's footprints on the chart. Study the displacement, hunt for those fair value DApps, and always respect your risk parameters. Review these concepts, stay disciplined, and I will see you in the markets. So I'll leave you with this one final thought. When the clock strikes 8:30 next Friday, will you be the liquidity, or will you be the one trading alongside the algorithm?